If you're writing off meals in your business, here's how to do it the right way so the IRS doesn't throw it out in case of an audit. If you're new here, my name's Alex. I run my own accounting firm where I specialize in working with small businesses and entrepreneurs to help them stay compliant and keep more of what they earn. And one of the most common questions that I get asked by clients is this meal deductible? And the answer is, it depends. And you would be surprised by the amount of misinformation there is online from supposed tax gurus that say that every lunch, every dinner, every late night Uber Eats, and even your personal chef, it's all deductible. That's just not how it works. And listening to bad tax advice can leave you exposed in the case of an IRS audit if they decide to take a closer look at your business. So in this video, I'll break down exactly how meal deductions work, what's deductible, what's not, and the proper way of tracking it. That way your expenses hold up in the case of an actual IRS audit. So let's break down how much you can actually deduct. Let's start with local business meals. They are 50% deductible. And these are meetings that you have over food with either a client, a business partner, as long as the purpose of that meal was specifically for business and you can prove it. Let's talk about a couple of examples to make it a little more simple. Let's say, for example, you're meeting with a supplier to work out a deal that you guys are going to be going into, and you decide to meet at a restaurant. That's 50% deductible. You decide to take a freelancer out for coffee to discuss a design project that you guys are both working on. That's also 50% deductible. But the thing to remember is you need documentation. That means who you were with, what was discussed, and the proof of paying for that meal. What I recommend is writing those notes directly on the receipt, then taking a picture and uploading it either to QuickBooks or whatever accounting software you use. Now let's talk about out-of-state or travel meals. They're also 50% deductible. Whenever you're traveling for business, let's say attending a conference or visiting an out-of-state client, meals that you have are 50% deductible. Let's say you fly down to Miami for 3 days for an industry event, and you had dinner at the hotel restaurant, and then you grab a quick breakfast at a cafe in the morning. Those meals are 50% deductible because you incurred those meals when you were away from your tax home, or basically the place where you normally work out of. Now let's talk about the exception, the 100% business meal write-off. There aren't very many of them, but they do exist. They include holiday office parties or team meals, meals provided for the employer's convenience, like if you have employees working overtime so you decide to provide them with a quick meal, and meals provided to the public. Let's say you're doing some sort of giveaway or promotional event and you're feeding a bunch of people. All those are 100% deductible. Let's dive into a couple of examples. Let's say you decide to hold a year-end event for all of your employees just to show them some kind of appreciation. That's 100% deductible. Or you decide to provide dinner for your team that's been working really hard and really late to meet a big deadline for a project that you guys have been working on. That's also 100% deductible. And finally, let's talk about what's not deductible, because a lot of people get tripped up over this. Meals with family or friends that had no business purpose are not deductible. Meals at home or on the go that are also not tied to any business activity are non-deductible as well. So the latte that you grabbed while you were running late to work on your way to the office, not deductible. Dinner with your cousin where you briefly mentioned your business doesn't count. And remember, in order to deduct it, it has to be business related, documented, ordinary, and necessary for your trade or business. Now listen, understanding what you can deduct is only half of the battle, because the IRS, they're not just going to take your word for it when you say, hey, this meal was with a client and I get to write it off. They want proof. You need detailed records. That means who you met with, what you discussed, when and where it happened, why it was business related, and you need receipts to back all of that up. Because let's be real, most of us can't even remember what we had for lunch yesterday, let alone trying to recreate who we ate with 3 years ago. Let me give you a real world example of how bad it can get if you don't keep good records. Let's talk about the court case of Franklin Malik versus Commissioner. The taxpayer filed their 2014 tax return late, and they claimed around $140,000 worth of deductions in meals, travels, and other business expenses. But the problem was they didn't keep any receipts, they didn't have any records or any financial statements to back any of this up. And when the IRS came knocking, Mr. Franklin had to recreate his records not once, not twice, but 3 separate times. Imagine trying to sit down and remember every single meal you had, who you had it with, where you went from 3 years ago. That's an impossible task. Let me tell you a little secret. That court case did not go well for him. The IRS disallowed most of his deductions. So here's the takeaway. If you can't prove it, you cannot deduct it. This is why I tell every single client that I have, anytime you have a business meal, take some notes on the receipt, take a picture, upload it to QuickBooks. That way we can be 100% safe. That 15 seconds of work can save you thousands of dollars if the IRS ever comes knocking. Good bookkeeping isn't about being paranoid, it's about being ready. There's a famous saying that says, if you stay ready, you don't have to get ready. And when you keep good financial records, any IRS audits just become a tiny speed bump in the road and not a huge roadblock. So let's wrap this up and go over a few key takeaways that every business owner should remember when it comes to meals. Let's remember that not all meals are created equally. Some are 50% deductible, some are 100% deductible, and some are not deductible at all. Local versus travel meals have different rules. You need more than a receipt, you need documentation. Do not rely on memory. Record who, what, where, when, and why. If the IRS audits you, solid records will save you. The goal isn't to just deduct everything you can. The goal is to deduct with confidence. And that only happens if your records are clean, your strategy is smart, and you have somebody in your corner that's looking out for you and making sure everything stays compliant in the eyes of the IRS. If you're tired of guessing what's deductible and what's not, let's change that. I work closely with all of my clients all year long to make sure their books are compliant, make sure they're ready in time for taxes, and most importantly is to make sure they're not leaving money on the table. Click the link in the description to see what it's like working with an accounting firm that actually cares about you. And if this video helped you out and helped you understand the tax law a little bit better, give it a like, subscribe to the channel, and share it with a business owner that you know, because this information can potentially save them thousands of dollars.